Let me bring on board Gurmeet Chadha, who's also here to give us a perspective on what this means. Gurmeet, uncertain global macro, but India getting a big thumbs up on the eve of Independence Day.
Absolutely, couldn't have come at a better time, especially when we are grappling with host of issues. If you see, India is probably the only market which has underperformed in last couple of weeks, largely due to tariff and trade war issues. Japan made a new high. We've seen U.S. markets scaling new high. S&P made new highs. Most European markets made new high. And I think this couldn't have come at a better time. And I think it was long due. With a series of reforms government has done, fiscal consolidation, India now being the fourth largest economy and the fastest growing. So I think it was long due. Ideally speaking, although you may say that asking for more, I think we deserve much better. We were ranked at par with likes of Thailand, Romania, etc. With our external debt position is much better. And I think couldn't have come. And I think the banking cleanup which has happened, corporate balance sheets being deleveraged, this will have a lot of long-term implications, including to flows in bonds as well as a serious reduction in FPI selling.
Gurmeet, hi, Mahima also joining in. Just want to get a sense, we've already seen the fall in the 10-year yields already. What do you make of this in terms of where the yields go from here on, as well as the India dollar impact, rupee dollar impact?
I mean, very good question. I think, and I've been making this point, Mahima, with Harsh and Neeraj also for a while, that long duration bonds are the juiciest in terms of asset allocation right now. And I've been saying this for almost 12 months when the yields were 730. I think now with inflation being 1.5 and WPI being negative, I think the terminal repo rate can go to 5, maybe 25 bits below that. And with 10-year GSEC typically, is about 50 to 75 bits over repo rate. So we can see 10-year yields sub 6, which means, you can see another 30 to 50 bits rally on bond yields, which also means corporate bond yields will come off and cost of funds come off. And I think that has a huge bearing on the overall system, the credit offtake, the banks in terms of the treasury gains they do and cost of funds falling. And I think overall people have forgotten, because we have been so used to high rates and high yields. What does let's say a 6% home loan do to consumption and housing? What does a 6% car loan does in private consumption? So this has huge ramifications, along with, I think, interest rates coming down. I think, as I said earlier, couldn't have come at a better time.
Our Executive Director, Neeraj Shah, also joining us on the phone line. Gurmeet, be with us, please. Neeraj, what do you make of this? What's the editorial take? Neeraj, can you hear us?
Yeah, loud and clear. Can you hear me?
Yes, we can. Please go ahead.
Yeah, I'm saying, Harsh, it'll be interesting to see if there are further dead economy tweets or social posts coming out, but be that as it may. I mean, that's the joke that every corporate leader that I send this message to sends back to me. So this is a shot in the arm, right? I mean, and it has immediate repercussions, some of which Gurmeet spoke about. And I wonder if there is a pattern in the way global rating agencies in the last 12 months have gone ahead and given a thumbs up to India's economic standing is. Now, whether the economy is slowing down and the pace at which it is slowing down is a different question altogether. This is more about the balance sheet strength of India and whether India's economy is able to absorb shocks, if any, right? In some sense, the rating does that. And I think that is, therefore, this is a thumbs up to my mind. I would love to hear, of course, what Gurmeet and other people have to say. But yeah, this is a well-expected shot in the arm, if you will, for India. It's just coming at an interesting juncture, Harsh.
Right. So, Gurmeet, we've spoken bonds, and Neeraj also, please be with us. Gurmeet, we've spoken bonds and how you're positive there. What's the immediate bond impact, and what do you believe the cascading impact on equities will be, Indian and in the global context? Give us that perspective.
So purely from an investor point of view, because we manage public money, I think that if you see, there's a lot of gap even between the 10-year and the 20, 30-year bond. Traditionally, this gap is not more than 10, 20 bits, but because of the FI selling, post RBI change in stance even in bonds, and the market is slightly illiquid, relatively liquid versus 10-year, not liquid in absolute sense. The gap almost went up to 50 basis points. So I think any long duration fund, from an investor point of view, you will benefit from the compression as well the overall fall in yield. So I'll not be surprised if the next 1 year return in bonds could be double digits. Won't be surprised there. Secondly, as I said, there's a lot of impact on the overall cost of borrowing and the perception in general. Because see, mind you, we have just got included in the global bond index, and there were already some news of JP Morgan reconsidering India's weight, etc. So I think we need long-term bond flows as well. A lot of time we are so focused on FPI flows in secondary market. We forget that we need bond flows. And look at this way, income tax amendment has happened, and I'm surprised it hasn't been covered as much. I was speaking to Neeraj also on this, that now the sovereign funds, the pension funds can invest in infra sector with exemption on dividend and capital gain. Now, if you add all of these things together with the rating upgrade, higher FPI flows in bonds, income tax exemption towards infra, you can see massive foreign capital coming. I think just need to act on this now and do more things to deepen the corporate bond market in particular. I think that could lead to significant benefits for the overall economy.
Okay, all right. Gurmeet, we've also got the short-term ratings from that report, and we've got that upgrade there as well from A3 to an A2 is what the short-term ratings have also been raised at. In terms of what Neeraj was also earlier indicating, saying that the tweet about the dead economy that was just defied by this take that S&P has given on India overall. Any message, according to you, that you would want to give the viewers through this particular upgrade in terms of, because this move is coming on a fantastic day, just a day before Independence Day. So your view, one message that you would want to give the investors.
I always say, and this is my favorite quote, that every past correction was an opportunity. The current one always looks like a risk. And I think don't lose, belief in the long-term story of India. And I think time and again, different names come. Sometimes it's the wars, sometimes it's COVID, sometimes, now the tariff is the new war. I think things will keep coming. The names keep changing. Use these disruptions to build onto your portfolio and have the asset allocation in place. Sometimes what we do is we get carried away by a lot of noise in the near term and forget about the asset allocation. We missed out on gold giving 40% last 1 year. As I said, the last 1 year return for long end bonds is also double digit. So be more balanced in your approach, and any sharp correction due to external events in India, in my 20 years has always been an opportunity. So I think you first have to be a believer if you are an equity investor, and overall as a balanced investor, don't miss bonds and other asset classes like gold.
Right. Gurmeet, good afternoon. Hiral on this side. So, another question I have is, if you have to look at corporate India, basis the upgrade that we've gone in terms of India, companies which have a rating which was as what it was for India, do you see an upgrade coming in on that front as well, number one? And two, if that happens, how do the dynamics change for any of these companies?
No, it will happen. There will be definitely a rub-off even on some of the better rated papers. Now, if you already see, the bank credit was a little slower, but the corporate borrowing has picked up because AAA issuers like, let's say, Reliance and some of the NBFCs were able to borrow more from the corporate market. And, a lot of bond issuances in the last 2 months. So, it always happens in terms of, that's why I said it's very important to deepen the market, even beyond AAA. I also see some of the better run AA plus, also the spreads getting reduced on the credit side as well. So it's huge benefit overall. And, once you have low cost of borrowing, it also encourages you to borrow and do capex, especially in companies which are in capital goods, power utilities, and broad capex sector. So I think it has a lot of, implications. And I just hope these tariff issues are resolved, because the market would want to see that before making the next leap forward. That's why you see the reaction so far. I don't know what the reaction will be in the next half an hour, and today's expiry also has been still pretty muted. In a normal day, an event like this would have led to a big surge, while the bond market is showing it, equity is still not showing it. So I think it will have broader benefits for the economy and cost of borrowing and capex, and I think eventually it will get reflected in the markets too.